After inflation has reached the highest level for many decades, it is set to fall dramatically over the next few months. I'll explain why this is, why we will not notice very much, and look at whether economists may be proved wrong yet again on inflation. Recently, the UK government announced its plan to cut inflation in half this year.
So what's the plan to halve inflation? Well, we are investing a lot of money in renewable and nuclear power, and we've taken very difficult decisions to balance the nation's books.
Well, the government are 50% right. Inflation will fall, but it will be nothing due to the Chancellor's vague talk of investment, at least not in the short term. You could really put Mr. Blobby in charge of the economy, and inflation would almost certainly fall in the UK. Why is inflation going to fall? Well, last March we saw a surge in inflation due to higher oil and gas prices. This was on top of the COVID-related inflation, a strong US economy, and in the UK we were also hit by a devaluation, increasing import prices. The inflation rate measures the change of prices in the past 12 months. So ever since last March, inflation has included all the war-related surge in energy prices. However, to many people's surprise, even in the middle of winter, oil and gas prices are falling and are nearly as low as last February. As mentioned in this video, Russia's ability to influence global energy prices appears to be much diminished. What this means is that come March, this surge in gas and oil prices will go into reverse. Rather than pushing up inflation, energy prices will have a negative impact on inflation. And if oil and gas are cheaper, it means cheaper transport, cheaper petrol, cheaper food. And also, it's not just energy that is falling, but also goods which surged in price during COVID, like furniture and used car prices. They are also starting to fall as supply chains recover. If we ignore the 12-month lag effect, economist John Eckhardt claims that instantaneous inflation is already down below 2% in the US and the Eurozone, and that means the very recent inflation. Now at this point, you may think, well, I still see very high gas and petrol prices, which is true. They do remain high by historical standards. But it is important to remember a fall in the inflation rate still means prices will rise, just at a slower rate. And this is why households will not really notice any of the fall in the inflation rate, because average prices are still going up. And for those struggling to make ends meet, it is no consolation that prices will rise at 4% rather than 10%. The cost of living crisis is far from over, and in the UK it will take years to recover the lost real wage growth of recent years. Now, when trying to predict future inflation, we also need to look beyond the headline figure at something called core inflation. Core inflation measures the underlying price changes and ignoring volatile factors like food, gas and oil. The problem is that in 2021, COVID messed up all these measures. Supply chain problems meant that many random goods soared in prices: furniture, bicycles, used cars. And as a result, economists have struggled to understand inflation in the past year or so. Here Jason Furman references different types of core inflation. And if it looks confusing, don't worry, you're in good company. The point is, it becomes very easy to choose the inflation rate to suit your narrative, and there's so many to choose from. A less controversial guide for core inflation is wage inflation. And in the US and the UK, the news on wage inflation is perhaps more concerning. It is running at over 6%. And this high nominal wage growth will keep inflation somewhat elevated. But if we take into account the fall in real wages, which means adjusted for inflation, demand will remain weak, which will also help to reduce inflationary pressures in the economy. Now, back in 2021, inflation was high after the post-COVID economy reopening. However, many economists, such as Paul Krugman, felt the inflation would be temporary. But this was not the case. Surging energy prices caused inflation to rise rather than fall. So it was a cautionary tale, but economic predictions can easily be wrong. An inflation pessimist might point to low unemployment, upward pressure on wages, and China's economic reopening all could push up prices, and to say nothing of a potential new geopolitical shock. Yet on balance, I think this is unlikely. The prospects for global growth, even in China, are quite poor. The IMF predicts a recession for nearly a third of global economies. Combined with falling energy prices, we will almost certainly get a significant decline in inflation. But this will be of limited comfort to those who have seen a fall in their effective buying power, because the fall in inflation will not be enough to reverse months of falling wages. Another factor I will not go into detail now, but talk about in this video, is related to secular stagnation, low economic growth, and why interest rates and inflation are falling in the long term.